Let's dork out on some insurance. I'm Mike Vericki with Customers First Insurance Group, aka the Insurance Dork. Today, we're talking about directors and officers insurance, also known as D&O insurance, which sounds like boring corporate lawyer stuff, right up until your name gets listed on a lawsuit. And before you think, Mike, I'm not running a Fortune 500 company, hang with me, because D&O insurance is not just for giant corporations. It can matter for small businesses, nonprofits, chamber boards, condo associations, homeowners association boards, private companies, clubs, trade associations, and organizations where people are making decisions on behalf of others. And the real question is, if someone sues the people running the company or organization because of a decision they made, who protects them? Because your general liability policy may not. Your general liability policy might not protect your board members. If someone slips and falls at your office, that's usually a general liability conversation. If someone sues your board, officers, chamber board, nonprofit leadership, or association leadership because of a decision they made, that may be a directors and officers issue. D&O insurance is designed for certain management-related claims, things like mismanagement allegations, breach of duty, financial harm, or decisions someone believes caused damage. So don't assume we have business insurance means your board's protected. That's a very different question. What is directors and officers insurance? D&O insurance is designed to help protect the people who make management level decisions for an organization. That could include directors, officers, executives, board members, trustees, chamber board members, and sometimes committee members or volunteers, depending on the policy. In some cases, the organization itself may also be covered. The basic idea is this: if someone claims the leadership made a bad decision, failed to follow rules, mismanaged money, breached a duty, or caused financial harm, D&O insurance may help pay for legal defense costs, settlements, or judgments. And that defense cost piece is a big deal because lawsuits are expensive, even when you did nothing wrong. You could win the case and still spend a painful amount of money proving you should win the case. That's one of the main reasons this coverage exists. It's not just about paying claims, it's about paying to defend the people who get named in the claim. And that matters because leadership lawsuits don't always look like obvious insurance claims at first. They can look like disagreements. They can look like angry members. They could look like frustrated donors or investors, vendors, unit owners, chamber members, or employees saying, "Your decision costs me money." D&O insurance is not just for giant corporations with 40-foot conference tables and people pretending to understand spreadsheets. Small businesses, nonprofits, chamber boards, condo associations, HOAs, clubs, trade associations, and private companies may all need to think about it. Why? Because if you have people making decisions on behalf of an organization, those decisions create liability. A board vote, a funding decision, a vendor choice, a bylaw dispute, a membership dispute, a rule enforcement issue. Any of those can turn into a claim. So the real question is not, are we big enough for D&O? The better question is, could someone sue the people making decisions here? Why general liability usually isn't enough. This is where a lot of organizations get tripped up. They say, we already have business insurance, or our nonprofit has liability coverage, or the chamber has an insurance policy, or the condo association has a master policy, or we have property and liability insurance. Great! But that does not automatically mean you have D&O coverage. General liability usually focuses on things like bodily injury and property damage. Someone trips and falls at your office. A visitor gets hurt at an event. A contractor actually damages someone's property. That's usually general liability territory. D&O is different. D&O is about leadership decisions and allegations of financial harm. For example, a nonprofit donor claims money was used improperly. A chamber member claims the board acted unfairly or violated the bylaws. A condo unit owner says the board enforces rules unfairly. An investor claims leadership misrepresented information. A vendor says an organization's leadership caused financial damage. A member claims the board failed to follow the rules. This is not the same as someone slipped on the ice in the parking lot. That's why we have liability insurance is not enough of an answer. You need to know what kind of liability insurance. Chamber, condo, and HOA board example. Here is a good example of where D&O can matter. Chamber boards, condo association boards, and HOA boards. Let's say the board makes a decision about membership rules, event management, sponsorships, vendor selection, assessments, repairs, rule enforcement, or how the organization funds are used. Then a member, unit owner, vendor, or other party says the board acted unfairly, violated the bylaws, failed to follow procedures, or caused financial harm. That's not really a slip and fall claim. That's a leadership decision claim. And if the individual board members get named in the lawsuit, the question becomes, who's defending them? A chamber, association, condo, or HOA policy does not automatically protect the board from every type of lawsuit. If someone slips and falls at an event, that may be a general liability issue. But if a member, unit owner, vendor, or sponsor sues the board over bylaws, rule enforcement, vendor decisions, membership decisions, assessments, repairs, or how funds were handled, that may be a D&O issue. That is a leadership decision claim. And if individual board members are named personally, the question becomes, who is defending them? That's why boards should understand whether they actually have D&O coverage. Who should consider D&O insurance? You may want to review D&O if your organization has a board of directors, a nonprofit board, a chamber board, officers or executives, multiple owners, outside investors, a condo association or HOA board, a club, chamber of commerce, trade associations, or any leadership group making decisions that affect employees, customers, vendors, investors, donors, members, sponsors, residents, or the community. And this is especially important for nonprofits, chambers, clubs, and associations because a lot of board members are volunteers. They're trying to help. They're donating time. They're showing up after work, reviewing budgets, voting on decisions, supporting local businesses, helping the community, and trying to do the right thing. But being a good person does not automatically prevent you from being named in a lawsuit. And being a volunteer does not magically create protection. This is the biggest misconceptions around nonprofit, chamber, and association boards. Being a volunteer board member does not make you lawsuit proof. A lot of nonprofit, chamber, and association board members think, I'm just volunteering, so I can't really be personally sued. That's a dangerous assumption. And if someone claims the board mismanaged money, acted unfairly, failed to follow rules, violated bylaws, or caused financial harm, the board members could still get pulled into the lawsuit. D&O insurance can protect the organization and the people serving in leadership roles. Good intentions are great, but good intentions are not an insurance policy. Nonprofit and chamber example. Let's make this more practical. Imagine a small nonprofit or chamber raises money for a specific program, community event, scholarship, fundraiser, local business initiative, or member project. Money comes in, decisions are made, expenses are paid. Vendors are selected, members or donors are told how the money will be used. Then later, A donor, a member, sponsor, vendor, former board member, or another party claims the money was not used properly. Maybe they say the board misrepresented how funds would be spent. Maybe they say the board showed favoritism. Maybe they say the funds were mismanaged. Maybe they say the board failed to follow the organization's own rules. Even if the board strongly disagrees, the organization may still have to defend itself, and individual board members could potentially be named. That's where D&O insurance can become extremely important. Not because the board did anything wrong, but because allegations still cost money to defend. And frankly, many small nonprofits, chambers, and associations don't have unlimited cash sitting around to pay attorneys. They may have enough to run the program, host the event, support the members, or pay basic expenses, but a lawsuit? That can be a different animal. Not the cute nonprofit animal rescue kind of animal, more like a raccoon in your attic at 2 a.m. kind of animal. Now let's talk about private businesses. D&O can matter here too, especially when there's multiple owners, investors, officers, executives, or outside stakeholders. Maybe the company takes on investors. Maybe ownership changes. Maybe a business decision goes poorly. Maybe one owner believes another owner made decisions that damaged the value of the company. Maybe someone claims leadership, misrepresented financial information, failed to disclose something important, or made decisions that benefited one group at the expense of another. That can become a D&O issue. And again, this is very different from general liability. General liability is not designed to clean up every leadership dispute inside the business. Now, not every small business needs the same D&O policy. A single owner business with no board, no investors, no outside leadership structure may have a very different exposure than a private company with several owners and investors. That's why this should not be a scare tactic. The insurance dork answer is not, everyone must buy D&O immediately or the sky will fall. The better answer is understand the exposure. Look at the organization and how it's structured. Look at who could sue. Look at who could be named personally. Then decide whether the coverage makes sense. One thing most people miss, the different sides of D&O. Now here's where D&O gets a little nerdy, but this is important. When someone says, we have D&O insurance, that is not always enough information because D&O policies often have different coverage parts, commonly referred to as Side A, Side B, Side C, and sometimes will include Side D. And you don't need to memorize all this, but you need to understand why it matters. Side A is usually the part that protects the individual directors and officers when the organization cannot or will not indemnify them. In plain English, if your name is personally listed on a lawsuit and the organization cannot legally or financially protect you, Side A may be the part that matters most to you personally. Side B is different. Side B usually reimburses the organization when the organization does not indemnify or protect its directors and officers. So if the organization steps in, pays the legal bills, and defends the board member, Side B may help reimburse the organization. Side C is entity coverage. That means the organization itself may have coverage when it's named in a claim. For private companies, nonprofits, chambers, and associations, this can be very important. But you need to understand how broad the entity coverage is and whether it shares the same policy limit with the individuals. And then there may be Side D. Side D is not always included or highlighted the same way, but it's often tied to certain investigation costs, such as derivative investigation coverage. This is definitely not a read the policy, ask questions, and do not assume type of coverage. Now, here's the big point. You don't need to become a D&O coverage lawyer, but you do need to understand that D&O is not just one giant bucket where everyone is magically protected the same way. The policy structure matters. Whether the organization and individuals share the same limit matters. Whether the defense costs reduce limit matters. Whether employment claims are included matters. Don't just ask, do we have D&O insurance? Ask, what does our D&O actually protect? D&O policies often have different coverage parts. Side A protects the individual directors and officers. Side B reimburses the organization when it protects those individuals. Side C protects the organization itself, and Side D applies to certain investigation costs depending on the policy. So the real question is not whether do you have D&O. The real question is whether the right part of the policy responds when the claim happens. If you serve on a nonprofit board, chamber board, condo board, HOA board, or private company board, Side A is one part of D&O insurance you should pay attention to. Side A is designed to protect individual directors and officers when the organization cannot or will not indemnify them. In plain English, if your name is personally listed in a lawsuit, the organization cannot legally or financially defend you. Side A may be the part that protects you personally. So don't just ask, does the organization have D&O? Ask, what does the policy do for the actual people serving on the board? That's a much better question. Now we need to talk about what D&O does not cover, because this is where trust matters. D&O is not a magic force field. It does not replace every other policy. It does not replace general liability. It does not replace professional liability. And it doesn't replace cyber liability. It doesn't replace workers' comp. It usually does not cover intentional fraud, criminal acts, or someone personally profiting in a way they were not legally entitled to profit, especially once that conduct is established. It also usually doesn't cover bodily injury or property damage because those are typically handled by other policies. And here's another big thing. Employment-related claims can be tricky. Sometimes employment practices liability, or EPLI, is included with a D&O package. Sometimes it's optional. Sometimes it's separate. Sometimes it's limited. Sometimes it's excluded. So if your organization has employees, you don't want to assume D&O automatically handles employment claims. You want to ask, same thing with fiduciary liability, same thing with volunteers, same thing with committee members, same thing with the organization itself. D&O insurance is important, but it's not a magic insurance force field. It doesn't replace general liability, professional liability, cyber liability, workers' comp, or EPLI. It doesn't cover your bodily injury or property damage. It's not going to cover intentional fraud or criminal acts in most cases. And employee-related claims may or may not be included, depending on the policy. So don't just ask, do we have D&O? Ask, what does our D&O actually cover? Who does it protect? And what's excluded? This is where the real answers live. The cheap policy problem. This is another important point. D&O policies can vary a lot. One policy might include broader protection for the organization, while another might be more limited. One might include employment practices coverage. Another might exclude it. One might cover certain volunteers or committee members. Another might not. One might have defense costs inside the limit, meaning legal costs reduce the amount of insurance available to pay a settlement or judgment. Another might handle the defense costs differently. The limit matters. The deductible and retention matter. The exclusions matter. The retroactive date matters. The claims reporting requirements matter. The definition of insured matters. This is why it's not the kind of coverage where you want to look at the price and say, that one is cheaper. Let's do that. A cheap D&O policy that excludes the claim you're actually worried about, it's not very comforting. A cheap D&O policy can be like a helmet made out of graham crackers. It looks like protection until you actually need it. With directors and officers insurance, the details matter. Who's covered? Are volunteers covered? Is the organization covered? Are defense costs inside the limit? Are employment claims included or excluded? What exclusions are attached? A low-cost policy that excludes the claim you're worried about is not much comfort. That's why D&O should be reviewed carefully, not bought like a box of paper clips. Claims made coverage. Why timing matters. Now let's get a little nerdy. Many D&O policies are written on a claims made basis. That means the timing of the claim and when it's reported is extremely important. With many claims made policies, the policy in force when the claim is made is the policy you're looking at, assuming everything else lines up. That can include things like, was the alleged act after the retroactive date? Was the claim reported on time? Did anyone know about a potential claim before the policy started? Was there prior or pending litigation? Was an extended reporting period needed if the policy was canceled or non-renewed? This is where people get surprised. They assume, well, the decision happened 3 years ago, so we just look at the policy from 3 years ago. Not necessarily. Maybe if it was general liability. But claims made coverage does not always work the way that people think it works. That's why switching carriers, canceling coverage, or letting a policy lapse can create major problems if you do not understand how the policy responds. I know. This is the part where your brain wants to go make a sandwich. But stay with me because this matters. With D&O, timing can be the difference between a claim being reported properly and a claim becoming a giant headache. D&O insurance is often written on a claims-made basis, and that timing can burn you if you don't understand it. A lot of people assume if the bad decision happened 3 years ago, we just look at the policy from 3 years ago. Not always. With claims-made coverage, you need to know when the claim was made, when it was reported, and whether there was a retroactive date, and whether anyone knew about the issue before the policy started. That's why canceling, switching, or letting D&O coverage lapse should be handled carefully. The timing details matter a lot. Let's talk about the biggest mistakes organizations make with D&O. Mistake number 1, assuming it's only for big companies. That's just not true. Small organizations can have big lawsuits. Mistake number 2, assuming general liability covers board decisions. Usually, those are different coverage conversations. Mistake number 3, assuming volunteer board members cannot be personally named. They can be. Mistake number 4, buying the cheapest options without understanding the exclusions. That can create a false sense of security. Mistake number 5, not reviewing D&O when the organization changes. Maybe you added employees. Maybe you added investors. Maybe your nonprofit grew. Maybe your condo association took on a major repair project. Maybe your board structure changed. Maybe your organization started handling money. The coverage conversation should evolve as the organization evolves. The biggest mistake organizations make with D&O insurance is assuming that they do not need it because they are small. Small organizations can still have big lawsuits. A nonprofit board can be accused of misusing funds. A condo board can be accused of unfair rule enforcement. A private company can have an ownership dispute. A club or association can be accused of violating its own rules. The size of the organization does not eliminate the risk. The better question is, could a leadership decision cause someone to sue the people making that decision? If yes, D&O is worth discussing. Questions to ask before buying D&O. So if you're reviewing directors and officers insurance, here are some of the questions to ask. Who exactly is covered? Does it cover only directors and officers, or does it cover the organization itself? Are volunteers covered? Are committee members covered? Are advisory board members covered? Are employees covered for certain claims? Is employment practices liability, or EPLI, included? Is fiduciary responsibility? Is fiduciary liability covered? Are defense costs inside or outside the limit? What exclusions are attached? Is it claims made? What's the retroactive date? How are claims reported? What happens if the policy is canceled or not renewed? Does the policy fit the way the organization actually operates? This last one's important. A nonprofit is not the same as a condo association. A condo association is not the same as a private company. A private company is not the same as a professional firm. And a tiny volunteer board is not the same as a larger organization with paid employees and multiple committees. The policy should match the risk. Final takeaway. So here's the simple takeaway. Directors and officers insurance is not just extra coverage. It can be the coverage that protects the people making decisions on behalf of the organization. General liability may help if someone slips and falls. Property insurance may help if the building burns down. Cyber insurance may help if there's a data breach. But D&O asks a different question. What happens if someone sues the leadership because of a decision they made? And for small businesses, nonprofits, condo associations, HOA boards, clubs, and private companies, that's a question worth asking before there's a lawsuit. Thanks for watching The Insurance Dork, where we make sense of insurance without putting you to sleep.